Do you really feel comfortable knowing the current non-performing loan data? If not, stay tuned. Welcome to this week's edition of Note School TV, where we bring you an amazing guest each week, and this week will not disappoint. We have a fella that has that data that we just talked about. But before we bring him on, we're going to spend just a minute. And hey, guys, make sure and give us the thumbs up as far as liking the content that we bring to you every week. Make sure you also subscribe to the Note School TV channel and make sure that you hit that bell notification. Yes, I mean, hit it right now so that you will be reminded each week when we go live at 11:05 Central Time. Also, if you guys, as you guys are with us every week and you watch the content and you want to know more about what we do at Note School, please just simply go in and go to noteschool.com/TV, and we will be happy to get with you, share information about what we do, and just get you going in the note space, right? So with that, I am going to bring on our Chief Visionary Officer, our fearless leader, founder of Note School, Mr. Eddie Speed.
Hello, Joe. How are you?
Well, I'm doing amazing. How are you, sir?
I'm good. I am doing super. We do have a terrific guest today. He truly is a renowned market expert on mortgage data. And I've known him, had the pleasure of knowing him for many years. In fact, a few years ago, Joe, at NoteExpo, he was our keynote speaker, and he brought a lot of great data. You remember that?
I do.
He was super duper. And this is a guy that I really like and respect, and just so respect his work. And he is truly regarded. In fact, he has been, we were laughing before we started. I said, I've sat at a hotel bar somewhere, we eating late night food or whatever, and CNN comes on and he's on, giving a market update. So he truly is an expert, and you guys are going to like him a lot. So, Joe, without any further ado, let's bring him on, Mr. Daren Blomquist. Hello, Daren.
Hello, Eddie. Thanks for having me. Hi, Joe.
Hey, Daren. Glad to have you on today, man.
Great to be here.
Well, we built you up a little bit, but I don't think we built you up over past your professional capacity. And you have quite a responsible job. You're vice president of auction.com, and we'll let you tell us a little bit about what you guys do in a minute. But I've known you for a long time, and I've called you numerous times over the years and said, get me straight, help me understand this data that I'm seeing, or is this the best source to get it? And first of all, I've passed a lot of those ideas on to folks here on this show, and they don't know to thank you, but I will say to all of us, thank you, because you've been a good guide for me to learn from.
Absolutely.
Awesome.
Absolutely.
Yeah, I think I remember that first time you called back when I was back in at Realty Track.
Yeah.
During, I think it was, in the midst of or leading up to the last, that foreclosure crisis we all went through. Anyway, and you're a hard person to forget, especially just calling out of the blue. So ever since then, it's been a great relationship, and I've learned a lot as well, both ways for sure.
Well, Eddie, I'm going to drop off here and let you and Daren visit for a little bit, and I'll see you guys in a bit.
Awesome.
Joe.
Yeah. So, guys, I knew Daren when he was at Realty Track, and then now you've been at auction.com, Daren, for how long?
For 3 years now.
3 years.
Just it's a little different role. I am not out there in the media as much, but a funny story is actually, we don't do a lot of outreach trying to, back at Adam and Realty Track, we were trying to push some of the data out to the media proactively to get our name in the news. we're not doing that here at auction, but I still get calls from reporters, and I know that, something's happening in the market when I start getting some more calls. And just today I had 2 conversations with national media outlets asking me, they had seen, not to steal some thunder here, but they had seen some of what I think we may be talking about, some of the big jumps in foreclosure starts, and they're wondering, okay, what's going on? That's one of the signals for me, along with the data, when the media starts paying attention, that something's going on.
Well, I don't usually do this, but I don't want to. I feel like a lot of you guys in the audience probably have seen Daren, and you're probably in your mind going, "Where have I seen him?" So I wanted to read some of the places that you've been on before: the Wall Street Journal, New York Times, USA Today has quoted you. You've been on media outlets of CBS, ABC, CNN, CNBC, Fox Business, and Bloomberg. So if you feel like you're seeing Daren and you're like, I know that guy, then you're probably right. So Note School is honored to call you a friend. And I would say in the area of data, I would call, for what Joe and I do, you're a coach to us. You've helped us understand data. You helped us with a little bit of data even today, and like best reports and stuff. So we take it seriously. So Daren, our audience is generally probably somebody that's somewhat akin to a house buyer, or somebody that offers owner financing, somebody that's, real estate related, and somebody that would buy a non-performing note. They're not necessarily the hedge fund that would own 10,000 assets. There's somebody that would be, they might do a dozen, or they might do 50, or they might do a couple of hundred. So when we see a surge in numbers for non-performing notes, it's not the surge of numbers that it has to be 5 million loans in default, because that's certainly not the case today. But there is a surge of these loans that are pent up. And we want to ask you a lot of questions about today. I know you got a presentation, and I'm going to let you just sort of go with it, and I'll just kind of feed in as we go. But I think you're going to have some really great data about where the trends are.
Yeah, I hope so. And I think, strike that balance between just following what the data is telling us without trying to spin it too much either way, and I think that's where you're at as well.
Yeah.
Because I kind of hear both sides of it. There's these people kind of like, I guess, the bears in the market who, are predicting the sky is going to fall and it's going to be even worse than, 10 years ago. I don't see that in the data.
I don't think that's the case. I don't think that's the case at all. I have never bought. I started buying non-performing notes, Daren, in 1986. I've lived through several cycles, and I've never bought non-performing notes in a hot real estate market before. So this element, this market condition of, yes, we have a hot market, and yes, there are some delinquent notes, a good many. Mm-hmm. Then that element, I've never seen those happen at the same time. So believe me, I'm the last guy on earth that wants the sky to fall and the market to fall.
Yeah, absolutely. So we don't see that, but then there are the other side of folks who think that somehow we're going to come out of this, and just because people have home equity, and we'll talk about this more probably, that they're going to be saved from delinquency and foreclosure, and unfortunately that's not the case, and there's some probably psychological reasons behind that.
Yeah.
The hot thing in the economics world of the last decade has been behavioral economics.
Yeah.
Which, classical economics argues that everybody behaves rationally. Behavioral economics argues that no, not everybody behaves rationally. And I think we see that with some of the data in the fact that you do have this hot real estate market. People have tons of equity, but at the same time, we still see these pretty large delinquency numbers and foreclosure numbers in the market.
Well, and in some cases, let's be honest about it, people hadn't paid for several years. The loans we're buying right now are the legacy loans, and you and I talked about that before we started today. They're loans that were delinquent before the virus, and the average delinquency is 40 plus months. Like, they hadn't made a payment in a while, and they may need a nudge to go do the right thing. They owe somebody some money, and I'm a note guy. I've been that my whole career. I think home ownership and the mortgage industry provides a great opportunity, but at some point the borrower does owe the money, right? He promised to pay. I wanted to talk to you. I want you to talk a second though, before we turn your slides up, talk about auction.com. I don't think that people really realize auction.com's main business today.
Sure. Yeah. Thanks for the opportunity. We auction off properties at the foreclosure auction, which are traditionally on the courthouse steps. We're trying to push more of those online to make them more available for folks. And then we also do the REO auctions, or bank-owned auctions, once a property has been foreclosed, taken back by the lender. And most of those are online. And on the foreclosure side of things, we handle close to 40 to 50% of all of those foreclosure auctions across the country. And so we're a big part of the market there. And yeah, so that's what we do. But we're a site where if you're looking for property, we don't auction off notes, but if you're looking for property, we auction those off across the country. And it's pretty exciting to have come here, and we have just a lot of data. I'm a data guy around how we're a marketplace. We're a marketplace within a marketplace. And we have a lot of great data that shows how buyers are behaving, how our bidders are behaving, how aggressively they're bidding, and then also our sellers, which are the banks and the servicers, how they're pricing their properties, setting their reserves. So it's a really rich data environment to see. And I feel like our marketplace actually sometimes predicts what's happening in the larger marketplace. So that's a lot of fun as well.
Well, just to our listeners, just to make sure that you didn't misunderstand him, they handle 40 to 50% of all the foreclosures in the United States. They're the facilitator. It goes through the legal process, but the vendor that drives the process on behalf of the guys that own the notes is auction.com, and that's how big they are. So Daren is his area within the company, his roles are related around data. And so to get him on and hear what their perspective is and what they see is just huge. So with that, Daren, I'm gonna let you show us some slides. I think our listeners will like that, or our watchers will like that.
We can dive into the data. Okay, there we go. So This is just to set a historical perspective. These are what in auction.com, we refer to this as foreclosures brought to auction. So these are properties that actually go to the foreclosure auction and are either sold to a third party buyer, investor, which probably, I would guess many of your listeners who are buying notes have also at some point in a past life or a current life are buying these properties at the foreclosure auction, as well as a diversified investment strategy, or the other, if they don't sell to a third party, they go back to the lender. So the blue is the REOs that go back to the lender or the bank, and the green is what's sold to third parties. If you look back there, the middle finger right in the middle of this is 2010, when we had close to 1 million of these happening, and you had a period of about 5 years where very elevated foreclosure volumes. And this is not just, by the way, this is not just auction data. This is public record data. So this is virtually the entire market, and not just the auction footprint, auction.com footprint. But you see now, 2020 and 21, all of a sudden, 2019, we were already back to pre-Great Recession levels. We were back to about 200,000 foreclosures a year. You see what happened in 2020 and 21. Largely, there was the foreclosure moratorium, the forbearance programs that cut off foreclosures, and artificially so, I would argue. Now, I would also argue those were very good programs in light of the shock to the economy that the pandemic represented. But the consequence is you do have a lot of foreclosures that were prevented that were just a result of the shock. But then you also have volume of foreclosures, the delta between that 200,000 in 2019 and what you're seeing in 2020 and 21, which is sub 100,000, many of those would have been foreclosures that would have happened without the pandemic, right? And so you have this backlog built up. And so when we start modeling out what we think is going to happen in the next 5 years, here's what it looks like. And this is based on, data-based models that go back and look at the connection between unemployment rates, seriously delinquent rates, and equity as well, and then spits out, predicts foreclosures. And so what we're seeing is there's two scenarios here. And certainly we can't predict the future, but we see the blue line is the more conservative scenario. If assuming home prices continue to go up, not quite at the rate that they've been going up this year or in 2021, but continuing to go up at a solid pace. And so you still have that equity there. You see the blue line, but you see the numbers spiking up there, in 21 to 2022, almost reaching in 22, almost reaching the 2019 levels, and then going above that for a few years. And that's in a very conservative scenario of 200,000 a year. Now, if you add in an element of, and I think there is reason to believe that this is a plausible scenario, that home price appreciation could slow down pretty dramatically and potentially even we could see a correction in home prices, then you would see more of the green scenario, where we're seeing that foreclosure volume return up and go up to about 400,000 a year, which is about half of what we saw at the peak of the last recession, but still elevated volumes there.
So Daren, I wanted to ask you a question about that. As I told you, I've never bought delinquent notes in a housing boom before. I bought delinquent notes in a lot of markets after a crash, but usually real estate was diving like a knife. I mean, it was like a dropping knife, right? And if we got to the green scenario, you're not talking about a 2008 crash, right? You're talking about an adjustment, but not something like that. Or give us some sense of what you think.
Yeah, that's predicting home prices go down at the most around 10%. So not in the 2008 crash, nationwide, we saw home prices down about 30%. In some markets, it was like 50 or 60%. So not a crash on that magnitude, but a slowdown and a slight correction in home prices.
Awesome. Thank you.
Yeah. So that's what we're seeing. I did want to show you the delinquency numbers here. This is just some data to support that we could see slowing home price appreciation. There's many factors here, but when we see inflation rising and that putting upward pressure, the Fed now putting upward pressure on mortgage rates, we've actually seen a slowdown in home price appreciation twice in this last 10-year housing boom. Once in 2013 and 14, once in 2018-19. And in both of those cases, it was largely a result of the Fed raising rates, which push mortgage rates higher. So I won't dive too much into this slide unless you want to, but this is basically making the argument for that green scenario that is a plausible scenario.
I did want to talk to you a little bit about mortgage rates, and we fully understand that any of us are throwing a dart at the wall, right? But you guys, you have a good scope of the market. Where do you see mortgage rates? I mean, the mortgage rates are rising quicker and faster, or have, than we've seen the other markets. And so are they going to let the other market catch up, or are we going to see a continual increase in mortgage rates?
I think we're going to see a continued increase. Now some of the market is responding. The Fed has been very, at least in the last couple of months, has been very aggressive, I guess, in communicating that they are planning to raise their federal funds rate. And I think the market is already baking in at least a quarter point rise. So when the Fed announces, which they probably will later, this month, that they're going to raise rates a quarter point, when they actually do that, some of that is already baked into the market. But inflation can be a nasty and troublesome problem for an economy to deal with. And so I think they're willing to take some of the downsides that come with higher interest rates and mortgage rates to prevent the economy from falling into kind of an inflation tailspin. And so I think we will see mortgage rates rise, and that is no doubt going to put downward pressure on home prices. We actually saw in 2019, I would argue that market was already more naturally kind of slowing down in 2019. And we saw, at least according to the public record data I look at, we saw 1 month where home prices actually did go negative in 2019. Or it was at least at slightly negative, basically 0% appreciation. And then so I do think we are in for at the very least, a slowdown in home price appreciation as those mortgage rates go up. I would argue that's a best case scenario. If we don't see home prices slow down, we will undoubtedly be entering another housing bubble that's unsustainable, if we're not already there.
You and I were in a mastermind together back in 17 and 18, and I don't know if you were there, but about once a year they would have, various economists come and talk about real estate markets, and I'm sure you addressed them there yourself. But we were pretty much thinking in 2020 it was almost a guarantee that we were going to see an adjustment in the market. This is prior to the virus, right? Mm-hmm. And that we just had sort of cycled out. We were sort of in that fourth quarter. People talk about, 4 cycles of the market, and then all of a sudden, of course, leave it to me. I mean, of course, none of us have ever operated in a pandemic before, but everything that should have happened in my mind because of the pandemic, the opposite happened, right? That half the people would not list their property, right?
Yeah, and then it had a lot to do with the massive government intervention there. So, yeah, this is inflation. Every time we've seen inflation go above, or not every time, but the last 3 times inflation rose above 5%, we've seen a recession. So that's another risk that isn't even really baked into that green forecast that I talked about earlier, is that inflation, it's more of the response to inflation, but the Fed's goal is to push the economy, to prevent more inflation. It's to push the economy toward recession. They ideally don't want to push it into recession, but a lot of times we see that happening, is that the economy goes into recession, and that at least saves it from inflation, which is considered a worse problem than a recession. So that's also a risk factor on the horizon, that could add even more risk than just home price decline. I would urge, this is just a quick, there's a professor in Florida who's doing this. You can go in and see by market where home prices are versus where he would expect them to be based on his home price model. It's pretty interesting to see. You see a place like Boise, Idaho, during the last so-called housing bubble, you see that blue line the light blue line goes a little bit above the expected, but now it's 76% above the expected. So a market like that is certainly potentially in bubble territory. Anyway, getting back into the delinquency pool, the red lines here are the seriously delinquent loans, which would be the best candidates for non-performing notes, I think, as well as potential foreclosures. And we did see that spike right after the pandemic there. You see that get up to close to 2.5 million loans that are 90 days or more delinquent, plus you have the foreclosures on top of that. Now that, thanks to the moratorium and the forbearance, we have seen that backlog of seriously delinquent shrink. However, if you compare it to pre-pandemic, we're still, if you add the seriously delinquent and foreclosure together there, we're still at about 1 million. And this is according to Black Knight, which doesn't encompass quite the whole market. If you look at, I was just talking about this with you earlier, Eddie, but the Philadelphia Federal Reserve does a good job of taking the Black Knight numbers and extrapolating to the whole market. They're saying more like on the order of over 1.5 to 2 million that are in that high risk stage. So it's definitely come down, but it's still elevated, and it's from that pool that we would see the non-performing loan sales, as well as potential foreclosures going forward.
Well, I think one thing, Daren, that I feel like is going to happen this time, and I'm curious how you feel about this. We're not going to see a lot of these properties actually get to the courthouse steps. Foreclosure is going to get initiated, but they have equity, and so the property owner hopefully will take their problem and turn it into some lemonade because they have equity, and not let it get to foreclosure. And they're going to have the opportunity to do that. And so I think there's a lot of people, the notice of defaults. I feel like the notice of defaults are always going to, for the next many months, are going to be shocking numbers, but they're going to be shocking because we have a pent-up inventory, a whole bunch of loans that were delinquent before the virus and a whole bunch that became delinquent, and the lenders have to deal with it.
Yep, absolutely. Here's those Philadelphia Federal Reserve numbers I was talking about. And this is actually a month old. These numbers have changed a little bit, but basically you see these numbers. I don't know if you, they're in the table in the middle of the screen, 1.2 million 90-day plus delinquent that are not, and these are not in forbearance, they're not protected by forbearance. And so that's that pool. But I agree with you, and I actually do have, here's what you're talking about with that 700, almost 700% month-over-month increase in foreclosure starts.
Wow.
In January, according to Black Knight, and so we see that number, and I have two different sets of numbers talked about.
And Daren, I wanted to ask you a question. Aren't these foreclosures more on the legacy loans than the loans that became delinquent during the virus? Is that true?
I think so. Now, Black Knight has actually said it's about 50-50. That was actually a little bit surprising to me. 50% pre-pandemic, 50% initiated or that went delinquent during the pandemic. But see, I would argue that many of those are not necessarily caused by the pandemic, but they're those foreclosures that would have happened even without the pandemic, that got held back because of the moratoriums. This slide here shows, to your point, it's maybe a little bit complicated to understand, but the bottom line there is the percentage of foreclosures that were happening each year that were tied to the last housing bubble, 2004 to 2008. And so we saw that number, back in 2015, 51% were tied to the last housing bubble. It was slowly going down by 2019, and even 2020, we were at 31% tied to the last housing bubble. That actually spiked in 2021 to 38% and I think that's because kind of the phenomenon that you've described, you've seen a lot more of those legacy loans coming through, is because nothing else was available to come through the pipeline in some ways. And so a higher percentage were coming through from those legacy loans.
Well, I want to do a little break here if I can. I want to have a word from our sponsor, which is Note School and our one-day class. But I want to come back and talk next with you about what I see here, which is FHA foreclosure inventory, and I hope you guys are enjoying this. You are listening to the ultimate expert, in my opinion, Mr. Daren Blomquist, and we'll be back in a moment.
Well, hello, everyone. It is Brian with the teaching team here at Note School, and I'm excited that I get to be the one to invite you to the upcoming Gold in Notes class. That's right. It is a one-day deeper dive class that we call Gold in Notes because of how valuable this time spent is. This is a full day that we really get to dig into the nitty-gritty, the whole world of creative financing, not just how to acquire more deals, how to get access to more capital, how to defer a lot of the taxes for us as well as for the sellers that we're talking to, and really learn how to create your own notes. And really, once you learn how to create your own notes, this is really where we spend an entire afternoon really pulling back the curtain on what the note business is, from wholesaling notes, buying and holding performing notes to really build your wealth. I'll even show you a strategy called partials, which is by far the best wealth building tool I've ever seen in the real estate space. And we're definitely going to spend some time talking about non-performing notes, which is by far the biggest opportunity in today's marketplace, solely because of the events that have happened over the past couple of years. This is when people are not paying their mortgages, and we're going to make a lot of big money from these bad debts, and we're going to help a lot of people get a second chance. It's an absolutely fantastic day. Come spend a day really dig in and discover a lot of this stuff so that you too can start building your wealth. It's a day meant to really be engaging. Bring your questions, bring your comments, bring your business problems, and we will see you there.
All right. So let's talk about the GSE loans. There seemingly, Daren, there was a big imbalance to me between Fannie and Freddie and FHA as far as delinquency.
Yeah, absolutely. We saw the GSE loans performing much better, and not really seeing the types of delinquency spikes. Now they did spike, but the FHA delinquency numbers were seriously delinquent numbers were close to 15% at the worst of the pandemic, whereas the GSEs, I believe, were maybe at 5%. So you see a big disparity there. One of the data sources I look at quite a bit that may be valuable to your listeners is there's FHA or HUD puts out publicly available data on what's going on with their loans. And it's called, if you go to FHA Neighborhood Watch, you can go and you can actually download the data yourself. And this slide is just me looking at that. And you can download it each month. And I was comparing July 2021 to December, which July 2021 was before the foreclosure moratorium had expired. It expired at the end of July. Mm-hmm. And then obviously December, basically the moratorium had expired. There was another CFPB rule that was expiring that protected from foreclosure. And we did see, a big spike. And again, I'd caution that these big percentage increases, and maybe I haven't said this, but these big percentage increases that we're seeing are coming off extremely low numbers. And so we're still below pre-pandemic levels, but we're starting to see this volume return. And so this was pretty amazing. I mean, we saw back in July, we were seeing about 15,000 properties, FHA loans that were actively in the foreclosure process. And that jumped by 512%, by 78,000 by December. And so you definitely see movement happening. The servicers are, taking off the shackles and starting to move forward on some of these foreclosures, which, to your point, these do not all equate to completed foreclosures, but this could motivate the homeowner to sell, it could motivate the servicer to sell their loans, some of their non-performing notes. And so that could be an outcome as well. But we certainly see some of these big increases, and you see it's pretty widespread across the states. Even in New York, which has notoriously slow foreclosure process, we see a big increase there in terms of property FHA specifically foreclosure. So it's pretty consistent across the board. And Yeah. So there, I did want to skip down to, unless you had comments on that. I do have it here by.
I was going to ask you a question about FHA, Daren. Like, so FHA has 3 times the amount of seriously delinquent notes at its peak than what Fannie and Freddie had. And proportionally, is that still the number?
Well, that was the percentage. So it's not the number of notes, but it's the number of loans.
Your percentage of their portfolio. Yes.
Yeah. So, and I think they have come down quite a bit, but they are roughly 2 to 3 times what the GSEs are. So they're, and we were saying this, going back to pre-pandemic times, early 2020, we were actually thinking FHA was at pretty high risk even at that point, because FHA was really the outside, at least within the government-backed mortgage world, they were the riskiest game in town. There was not this wide subprime mortgage industry going on like we had 10, 15 years ago.
Yeah.
So we did see, going even prior to the pandemic, that was the biggest risk factor on the horizon. And that's proven, with a shock like the pandemic, that these loans are, not standing up as well. Really, it boils down to very low equity, 3% or less down payments with these FHA loans. And then also on top of that, you have higher debt to income ratios and other risk layering on top of that, even that makes these riskier loans.
Yeah, I mean, there was a saying at one time that FHA was the last subprime left. I'm sure that wasn't their saying, but it was certainly. I've heard it said in the industry, which is essentially matches up with what you're saying. The qualification standards for FHA were just lower than Fannie and Freddie.
Yeah, and I don't see it in the same category as some of the, what some might call toxic or predatory loans of the subprime.
Yeah.
But there's a trade-off, when you're trying to increase home ownership and get a broader group of people into home ownership, that you open up the credit box a little bit, and that does have a trade-off in higher delinquency rates.
All right, great.
So I did. There's some great data here from Black Knight on getting at that equity question we talked about. I wanted to touch on that. There's again a lot of data here, but on the right, if you focus in on the right-hand side graph, that is the roll rate of foreclosure start to what they call involuntary liquidation, which is basically completed foreclosure or short sale. That roll rate from foreclosure start to that involuntary liquidation by equity band. And not surprisingly, the folks with the most equity, which are the lower, lighter lines, have a lower roll rate. However, what stood out to me is that even people with over 40% equity, or the category there that's less than 60% combined loan to value or CLTV, even those folks with quite a bit of equity, a lot of equity, 30% of them, you have to kind of ignore the 2019 through 2021 numbers, because those are not fully baked and they were skewed by the pandemic. But if you look at 2013 to 2018, even those folks with a lot of equity, 30% of them were ending up with that involuntary liquidation or foreclosure. So it might be a surprisingly high rate. And it just, to me, it points out that even with home equity, at least home equity on paper, some of these distressed homeowners are not selling to avoid foreclosure.
Daren, you have any data about, I know that your clients clearly order property inspections. We all do, right? When we're doing pre-foreclosure work. Do you have a vacancy number on those?
On the pre-foreclosures?
Mm-hmm.
Yeah, we actually got a lot more rigorous about that during the pandemic, because the moratorium was it exempted vacant properties. And so the servicers themselves got a lot more rigorous about getting that data to us to make sure that the properties that were being foreclosed on were vacant. And so, I'm saying all this, and I don't have an exact answer because I don't remember the numbers right now off the top of my head. But I think certainly during the pandemic, almost 100% were vacant. We're seeing that swing back. We're seeing more occupied properties because the moratorium is lifted on those. And I don't, maybe you're asking.
Well,
you have a follow-up question that addresses what you're trying to get at.
Everything you're doing, of course, is awesome. It's national data. It really is the best analytics out there. But on our small book, or the small book that we continue to have a look at on a regular basis, we're shocked at how many of these properties are not occupied. And which goes to what you were saying. And the other thing is, I think it's interesting, like you're thinking, if somebody has 30% equity, why in the world would they let it get to foreclosure? But the lender doesn't end up, if they have that kind of equity, the lender doesn't end up with an REO. They don't end up with a property. Somebody buys it at the steps. In fact, the overage money over and above what the lender's owed actually goes to the borrower. Yeah,
and actually I skipped over that because I didn't know how much time we have, but that was my last slide. Is we see a higher percentage of folks with what we call with surplus funds at the auction.
Yeah.
And that does go back to the homeowner. So we see, a well-run foreclosure auction actually helps protect that equity for the homeowner. So that's that's a very well said. I think this slide actually speaks. Oops, I just lost. But that slide hit the wrong button there. That slide speaks to. Hopefully you can see it now. To share my screen, it speaks to the fact that during the pandemic, most of the properties were vacant, and we were actually surprised. The moratorium exempted vacant properties, and we were surprised at how the volume of foreclosures that were vacant that were still coming through. It was still much less than the pandemic, but we were seeing close to 30% of pre-pandemic volume during the moratorium, which indicated that at least 30% of properties in foreclosure were vacant.
So Daren, from your perspective, and obviously you have a huge perspective, because if up to 50% of all the foreclosures done, you guys are managing, so to speak, that's a pretty significant, market share. What percentage of those at the foreclosure sale go back to the lender? In other words, they end up with the REO property versus they get paid off at foreclosure. Do you know those numbers?
So the percentage that, make sure, can you ask that question again, just to make sure?
Yeah. So what I'm basically asking is, when the lender takes it all the way to foreclosure, how many times does the lender end up with the property after foreclosure sale versus getting their loan paid off, and they don't end up with the REO property?
The way we look at it is, and that is actually a very interesting number that's changed during the pandemic. That prior to the pandemic, about 40% of properties that went to the foreclosure auction got sold to a third party, and the rest went back to the lender as an REO. So
60% of the time the lender ended up with the property.
Yeah, it's actually reversed now. It's and because of the equity issue, and also just because there's such low volume, that we're seeing 60% sell to third parties at the auction and 40% go back to the lender. So the REO volume, if you look at it from kind of the REO perspective, that's even as the foreclosure volume gets turned back on, if that continues, we would see the REO volume still be pretty low, because a lot of it's not making through past that foreclosure sale.
Well, once again, our perspective is a much smaller window than yours, but we believe that about 75 or 80% of the loans that we are seeing that are delinquent notes are what we call an equitable foreclosure, meaning that they owe enough less than what the property's worth. The odds of ending up with a property aren't very high. We don't want to end up with a property, by the way. We really don't want to even end up with the foreclosure sale. If we buy a loan that's delinquent and we issue a notice of default and they have equity, we would just love to see them get the property sold and then them end up in a much better situation. That's what I would hope would happen. Of course, as you said, people make all kind of choices in life, and what we might wish for them might not be what they do. But
yeah, but I think the good news is that with equity, even if they don't make the best choice early on, that there are still options for them.
Yeah,
and they can walk away from the foreclosure auction with cash to show for those surplus funds at the auction.
All right, so we can see your screen. Yep. And okay. We are looking at your slide that's foreclosure tide gradually rising. And then, there's your map.
Okay. Yeah, sorry, I don't have it on presentation here, but I think this will work. Is just sure. This is a heat map just showing you where the foreclosure volume, where you see the foreclosure volume returning the quickest. The green is where we see the foreclosure volume returning faster. Oklahoma stands out there. It's the percentage there is the percentage of pre-pandemic volume. So actually Oklahoma's back up above its pre-pandemic volume.
Wow.
Now it's a little bit smaller. It's a decently volume state, but it's a little bit smaller volume on the smaller side. Another one that stands out is Indiana. They're at 86%, which is a fairly high volume state. I wouldn't put too much stock into North Dakota being at 183% because their volume is so low. Yeah. But these are some of the areas where foreclosures are coming back a little bit faster. Even actually California is at 50%. But you see in New York, which I mentioned earlier, has a slow foreclosure process, is only at 17%, and New Jersey at 18%. I believe, those are two states that had a lot of still legacy bad loans built up even before the pandemic. And so that's, even though the numbers there are low now, that's where we actually see a lot of potential volume coming down the road in states like that.
Well, it's interesting. I'm looking at Louisiana and Mississippi, and they're in the top 5, both of those states, as far as percentage of delinquent loans. Louisiana is particularly in a mess. They have double the amount of delinquent notes of most any other state. And look at them. They're only at 41% of where they were before the virus. They got a lot of ground to make up, right?
Yep. And I actually just saw I just was looking at this is from the fourth quarter. I was just looking at our first quarter numbers, and Louisiana was actually one of the ones that stood out as that number had jumped up above 41% now. It is starting to jump in Louisiana as well.
Well, Joe, if you will come on with us, you can. What do you think? A lot of data?
Man, I got to tell you, I have been making notes. Eddie and I, we're like you, Daren. We love this data, man. We talk it. We probably bore the heck out of people at get-togethers and so on. And so,
I know. When I try to talk to my kids about this, they glaze over.
Well, they know not to ask certain questions, right?
Sure. Well, Daren, you have once again, you have been helpful to us. We believe that you can't find out where a market void is if you don't know market data.
That's right.
Right, Daren. I will tell you this. I listen to Real Estate Forecast on a weekly basis. All of us do, and when they don't even mention defaulted mortgages, which they almost never do, then I have to somewhat disregard their whole market report, because this market data is a reality that we're not calling anything like the last crash, but there is a market situation to be dealt with. And I'm in agreement with you that that you have to have some global understanding. We fully understand there's a shortage of listings, right?
Yeah, absolutely.
So this is a counterbalance, not calling for the bomb or anything like that, but certainly saying that if you're in our business, this, of course, is for us, this is inventory.
Yeah.
Right.
Right.
And but more specifically, just an awareness of the market. So,
and I think, I mean, the argument we would make is that you can try to stick your head in the sand and ignore this, but we need responsible people buying these notes, and we need responsible people buying these properties at foreclosure. And that's actually what's going to eventually add more quality housing stock and more inventory back into the retail market when these properties are rehabbed, put back on the market. So I think if you're going to have a market that relies on financing for people to buy homes, that's always going to come with defaults and foreclosures. That's another trade-off for such a market. And so if you have a robust, transparent marketplace for dealing with those defaults and foreclosures, you're going to be better off in the long run.
Well, as I said, I started buying non-performing notes in 1986, and every market I had seen in the past, delinquent note market, it was like when we have a problem, we wash those problematic assets through the system. The last time, the theory was we're going to just push it out over several years, right? We're not going to rush everything to the market, and because if we do, we'll annihilate the market, and possibly it would have broken the banking system. It was so big. But the truth of the matter is that the zombie house thing and what I call the zombie loan thing was municipalities found out it wasn't good for them.
Yeah.
And so I hope in this cycle we're not going back to that, because just a guy that's been in it for over 40 years, I can tell you it didn't work. It wasn't good for people. It wasn't good for the municipalities. And so I do believe we got some inventory to work through. And I will say that we will pay close attention to what you've told us and learn from the data, and we'll try to make good decisions accordingly.
Awesome. Yeah, thank you for the opportunity to share some of this. And I'm very much on the same page with this middle of the road approach. There's going to be an increase in inventory, undoubtedly. We're already seeing it. That doesn't mean the sky is falling.
That's it. We're on the same page. Daren Blomquist, thank you. You have been a bright light for us today. Thank you very much.
Thanks, Eddie. Thanks, Joe.
You're very welcome. All right, guys. Well, again, thank you so much for being with us today. And let's thank Daren. Amazing data. I literally do have a whole page of notes there. So it wasn't just, sitting in the background, not listening. Guys, to hear more about Note School and what we do at Note School, simply go to noteschool.com/TV. And again, thanks so much. We will see you next week. Same place, same time, 11:05 Central Time on Wednesdays. And as we say every week, we'll see you on the other side. Bye now.